So what people are talking about, gee, this has got to be over, it's gone ballistic, etc. Two things are wrong with that. One, the spread is just about to break out versus the major asset category, meaning the game just beginning. And secondly, gold is only fourfold off of its prior bear low. Back into its 79 peak, the 1980 peak in gold, and at the 2011 peak in gold, it had had an eightfold bull market to get to those highs. We're only fourfold right now. So the game is not over. The game is just beginning.
Silver's recent pullback has done little to weaken the structure of this bull market. In fact, beneath the surface of what looks like consolidation, momentum has been quietly rebuilding. According to market technician Michael Oliver, silver's long-term trajectory remains one of the most explosive setups in modern financial history. The metal, after years of artificial suppression and investor neglect, is beginning to assert its true value. Its price behavior, when analyzed through spread relationships and momentum structures, reveals a market that isn't exhausted. It's just beginning to stretch its legs. Oliver's analysis points to a powerful breakout structure forming between silver and gold, a relationship he argues is far more important than the raw price charts themselves. He identifies the spread ratio between silver and gold as being on the verge of a multi-year breakout, a signal that historically precedes sharp vertical moves in silver's price. That ratio, hovering just below 1.3%, needs only a marginal push higher to ignite the kind of acceleration last seen in 2010 and 2011, when silver quadrupled in a matter of months. To Oliver, this isn't noise. It's the quiet before the surge. While many analysts have mistaken silver's pullback as the end of a rally, Oliver maintains that it represents nothing more than market fatigue before a structural pivot. Gold, in his view, is still in the early phase of its macro bull cycle, only fourfold above its 1999 lows compared to the eightfold rise that marked the 2011 peak. The implication is clear. Both metals have a long way to go, and the spreads, the intermarket relationships between precious metals and other asset classes, are the real indicators of where capital is migrating next. These spreads tell a simple but profound story. Capital is shifting, quietly but decisively, out of overvalued equity markets and into monetary metals. As these spread structures begin to break out across multiple time frames, they signal not the end of a move, but the birth of a new market reality. For silver investors, this means that the true acceleration phase of the bull market is still ahead, not behind. In his interview, Michael Oliver explains why he believes silver's next move will be swift and transformational, and why he's turning his focus not just to silver itself, but to the miners poised to outperform as the momentum spreads ignite. If you find value in deep, data-driven analysis of the precious metals market, make sure to like this video, subscribe, and share it with fellow investors who understand that timing, not just conviction, is everything in this market. We appreciate the support and hope you enjoy the video.
The pullback, I think, is probably largely spent, if not totally spent. In fact, that was like a week or so ago. If you'll just notice what's going on, like weekly close to weekly close, we're wheel spinning. It's not really going down, down, down. It went down and then it's wheel spinning. When we examine the short-term technicals of silver, like the day-to-day, week-to-week type stuff, it's building a base, which you can't quite see it on the price chart, but on weekly momentum, I could see a clear ceiling that's been built, such that, I'll give you a number, it's tentative right now. You get these silver back above about 48.09 next week. Okay, we'll get one more day this week, okay? And I'm going to break out of that base. So all you do is spin your wheels here. And I think that's what it's doing. I think it's next to meaningless. I know every time we get one of these, there's a whole crowd of internet analysts that say, oh, I got to go to $40 or 41 or whatever, and this is the this of the that and so forth. And I don't see it. I see it as a pullback buying opportunity. In fact, I'm making a list right now of miners to add to, because I'm shifting not just into silver related, but also the silver miners. As far as upside, the key trigger for us and we've stated it over and over for the last month or so, has been the spread relationship between silver and gold. Not the net trend or the momentum of silver or gold, but the relationship between the two. Because we've examined back in the past, and when silver goes ballistic, and again, within that 50-year range, which is ridiculous, I'll comment on that in a minute, $50, $50, $50, the surge that got you up to those levels in the final phase of the 79 to 80 bull, or 2010 to 11, where silver went up fourfold in 5 months, or went up 2.5-fold in 6 months, 2010 to 11. The signal that generated that change in silver's verticality was when it broke out versus gold. The spread relationship, not evident on the silver charts themselves. Right now, the spread between silver and gold is at 1.2%. Divide D silver to D gold, express it as a percent. The major breakout level is not far above 1.3%. So it doesn't take too much to blow that spread through a multi-year high. Did anybody, even an amateur technician, if you only looked at the spread chart, you could see the ceiling. You clear that and we're gone. The ballistic tone will change from accelerated price tone that we've had for the last, 5-6 months, where silver went from the 30s up to the 50s, boom, boom, boom. Then it will go into that next phase. And we're arguing that silver is about to do, again, waiting on that trigger level, spread silver gold, to go into a new reality. And it's not going to do it incrementally. It's not going to go from here to $150, $200 or something like that in a matter of, a year or so. It's going to do it rapidly. When mistakes are made by a market, the overpricing mistakes or underpricing mistakes, sometimes they're protracted. We see bubble tops sit up there and froth around for a long time, and then finally they fall apart. And you look back and say, oh, gee, I should have known that. Okay. Similar at bottom. Sometimes markets get undervalued, and investors just say, phooey with that market. It's a dog. Don't touch it. And when it wakes up so fast they miss it. That's where I think silver is right now. Anyway, so right now, if I were looking at one single chart, I would say look at the silver-gold spread relationship and the momentum of that, which we plot every week in our weekend reports. The momentum of that spread, which requires going from like above 1.2 to 1.32% to be precise, to break out. Momentum of that is already pushing at the breakout levels. And usually momentum will lead a spread chart breakout. When that spread breaks out, it says something's beginning. Okay? It's not saying, it's over. It's saying the race just began. And there's another spread that's very, very important. And that is between the gold measured against the U.S. stock market. And we've run numerous charts on that, especially last weekend's report where we went back to 2013. During that time, 11, 12, and 13, gold peaked and was headed down into a low that ended in late 2015. Well, obviously, during that time, gold was underperforming the U.S. stock market because it was really going down hard. And therefore, the spread was negative. Gold was underperforming. But since, I actually go back 11 years now, but from 2014, that spread chart, when you divide the price of gold into the S&P 500 and express it as a percent and simply plot that chart month to month, has a massive, super clear ceiling on it that you're bumping and bumping and bumping. It's now for the 4th time, okay? Right now, the spread, if you divide gold into the S&P, is at about 58.5% price of D gold divided into S&P 500. If you ever close a month at 60%, you blow that entire structure out and gold breaks out to the upside. This is a fresh signal, which when that occurs, it's not old. It's not saying, gee, I'm in an old trend. It's saying, I've just begun a major asset class shift. Now, when you do something else that we thought we should do in the weekend report, and sure enough, we were glad we did it. We know the S&P is distorted. It's like NASDAQ 100. In fact, you go to the top 5 or 6 stocks in both indexes, and you'll find that those stocks constitute 30% of the entire S&P 500. And you know what those stocks are. AI tech related. NASDAQ 100, the same symbols, five or six of them, constitute 50% of that entire index. So they're heavily front-end distorted. When we divide gold into the Dow Jones 30, or divide gold into the New York Composite Index, indexes people seldom look at anymore, we've already broken out. Whereas you've had that breakout. What it says then is that with the exception of those couple stocks, and by the way, look at those stocks today, they're getting hammered. Palantir, NVIDIA, et cetera, far more than the market. When you lose those leaders and gold breaks out versus the S&P, joining its already existing breakout versus New York Composite and the Dow 30, it's saying there's an asset class shift that just occurred. It's new. It's brand new. And whenever gold breaks out versus the S&P and surges in performance, it always converts into net price gain for gold. So what people are talking about, gee, this has got to be over, it's gone ballistic, etc. Two things are wrong with that. One, the spread is just about to break out versus the major asset category, meaning the game just beginning. And secondly, gold is only fourfold off of its prior bear low. Back into its 79 peak, the 1980 peak in gold, and at the 2011 peak in gold, it had had an eightfold bull market to get to those highs. We're only fourfold right now. So the game is not over. The game is just beginning.
Despite the volatility of recent months, Oliver sees the pullback in silver as largely complete. Weekly momentum charts, which he tracks closely, show the metal building a solid base just below critical breakout levels. Silver, he argues, has been wheel spinning, moving sideways while quietly absorbing selling pressure. Once it clears the upper boundary around $48, the next phase of acceleration could begin almost instantly. This momentum structure, combined with the narrowing silver-gold spread, sets up a rare alignment, the kind that historically precedes explosive multi-month rallies. This analysis flows directly into Oliver's broader framework, the rotation out of equities and into hard assets. He believes that spreads between gold and the S&P 500 are approaching a pivotal breakout point, signaling a fundamental reallocation of capital. The same dynamic that defined the end of the tech bubble and the early 2000s commodity boom is reemerging. But this time, Oliver argues, the spread dynamics are far stronger and the momentum signals far clearer. What we're witnessing, he says, is not a fleeting rally, but the early stages of a major asset class shift.
There's still, you could tell by looking at the hour-by-hour action sometimes of silver and gold versus the S&P, especially silver, because some people connect it only as an industrial metal, and therefore if the stock market goes down, silver must too. Okay, they're making a mistake. Okay, but you can see it in the hourly ticks where the short-term traders say, oh, S&P just dropped 5, let's sell silver off, it drops 25 cents, you know. And the game is going on still. It's a wrong thought process because when you stand back and look at the bigger picture, take for example, S&P made a high January, February, collapsed into April, 20% drop. What did gold do during that time? It exploded, not hour by hour, but month by month, okay? So S&P had a sharp, cataclysmic 20% drop. It scared most people, most of that occurring in several weeks of March and April. So it was really, almost crash-like, and yet gold went up, okay? So people need to rethink that assumption because it will trap them into missing something.
No, when we also look at Bitcoin, I know we've been seeing Bitcoin really collapsing in price recently, which is something that you've been predicting. What do you anticipate, and what is the momentum showing on the Bitcoin chart right now?
Well, we showed this over the last months, and especially back in a September report, we showed an overlay of the S&P 500 back in 1987 when it had been going up and up, and the price chart just looked lovely. Momentum had built a floor spanning a couple years where the price was going up, there was rising lows, but momentum was making the same low over and over and over again, where it was dropping down, the price was dropping down to its rising three-quarter moving average. And therefore the oscillator showed a repeated drop to the zero line, okay, a flat floor, a structure. When it broke it, it crashed. Didn't even wait around for the end of the month close to break it. It broke it intra-month, gone, okay. This is the fourth time that Bitcoin since 2023 has dropped down to its three-quarter average. That number this quarter is 101,390. Okay, we've been trading below and above that for the last few days, so we've come down to that structure again for the fourth time. We don't think it'll hold this time. The question is, do you wait for a close, monthly close below that number? We got a long way to go to the end of November. Or do you maybe assume this time, don't wait, it's not going to hold, just like an 87 for the S&P. That's our assumption. Now, does it have to crash? No, I'm not going to argue that. Crash meaning like 30%, a matter of a week or so. But it's a disastrous number regardless. And, it wouldn't shock me that when you break this, that 3 months later or maybe 3 weeks later, you see that the Bitcoin, which, by the way, is highly correlated to the month-by-month price action of NASDAQ 100, is 30% or lower below where we are now, meaning you could be 70,000, 60,000 or something on Bitcoin. Remember, its recent high was 127. It could cut you in half, much of it occurring rapidly. Now, the problem with Bitcoin doing that, aside from proving to the gold doubters that Bitcoin is an alternative to gold, which it is not, but it's linked to the stock market. Its inhale-exhale behavior since 2021 on Bitcoin monthly bar charts versus NASDAQ 100 is practically an overlay. They look like brother and sister. In fact, we ran those charts and removed the name on the chart and the price scale, and you can't tell the difference hardly. So if that Bitcoin breaks our structure, and it's down to it now, if you break it, credibly, like a monthly close, or don't even go lower than what you've already done the other day, like 99,000. It's likely to have a wave impact on NASDAQ 100 because the same speculative inhale-exhale fever is going on there. And sure enough, when we got Bitcoin getting bashed the last week or so, what's happening to NVIDIA and Palantir? Suddenly they become weak components of the S&P and the NASDAQ. Watch it. Watch Bitcoin. It's very important. All norms of technical analysis like RSI and so forth will be a total falsehood if you follow them. In other words, once you get silver up to a monthly RSI that's overbought, if you get out there, you're going to miss the move. Even back in, I think it was 79, you got monthly RSI above the what is the overbought level, stayed there for like 5 months. In other words, you should have bought the overbought level because it stayed there for 5 minutes, it exploded. In other words, all the norms get smashed. We have a situation in silver where for some reason, and one reason may be the artificial suppression of the market by certain banks, maybe inclusion with central bank, I don't know, where it stayed in a 50-year range. You go back and look at copper or lead. We ran those charts a few weeks ago, you go back to the 1970s, and you'll see that they were in a range, it's 1970s, 80s, 90s, into mid-2000, like 2005 or 6, where they were stuck in this orderly reality, up, down, up, down, up, down. And when they came out of it, literally in a few quarters, they quadrupled in price. These were different times. They weren't doing it together. Copper went up in like 2005, 6. Lead went up in 2007, so it wasn't the same driving force. But they quadrupled in price. And then since then, they've lived in a new zone of reality that's like 4 times the average price of that prior zone of reality. How come silver's still in the prior zone of reality? Look at gold. I mean, where was it in 1980? $850. Silver was 50. Okay, where was it in 2011? 1920. Where was silver? 50. Gold's 4,000. Where's silver now? 48? Okay, what's going on here? We know silver's in great demand by high technology. Solar panel production, Chinese are about 80% of that market. They need silver in the cells. And there's also AI demand for silver. Microscopic but pervasive, okay? It's a great conductor. And we know for 5 years now, the new supply has not met demand. There's been a deficit 5 years in a row, supply-demand deficit. And we know that when silver price goes up, it doesn't induce necessarily more silver production. Why? Because most of silver production doesn't come from silver mines. It comes from base metal miners who are primarily motivated and focused on getting copper out of the ground or magnesium or whatever. And silver's just marginal to them. Therefore, if silver price doubles, it's not really that much of an incentive for them to produce more. If silver matched lead and copper, it could go to $200. Okay. Now, and also, if you go back and look at 1980 high at 50 or 2011 at 50, and factor in the decay in the money in it, the buying power, the real buying power, the dollar, not the dollar index that's measuring paper versus paper, but the dollar quantity almost doubles every decade. 90% increase in the quantity of M2, Well, if you factored that in, silver probably be $200 now just to match those highs in real dollar terms. Wouldn't be exceeding them, it'd only be matching them in real dollar terms. So all kinds of things point to the acceleration phase going dynamic into a new reality.
Oliver's outlook is unambiguously bullish, not just on the metals themselves, but on the structural transformation they represent in the global financial system. He draws attention to how investors are still trapped in a reflexive mindset, assuming that if the stock market falls, silver must follow. That logic, he warns, will leave many behind. The data show otherwise. During recent equity drawdowns, gold and silver have diverged sharply higher. Silver's industrial use, often cited as a weakness, is in fact becoming one of its greatest strengths, with accelerating demand from solar, AI hardware, and electronics, creating an inelastic supply environment that no short-term correction can alter. Adding to this, Oliver highlights the historical absurdity of silver's 50-year trading range. While base metals like copper and lead long ago broke out of their 20th century price ceilings to establish new realities at 4 times their prior averages, silver has remained artificially restrained. The result is a market that is deeply undervalued relative to both its historical peers and the fundamental conditions of today's monetary landscape. If silver were to simply reprice itself in real dollar terms, adjusting for inflation and money supply growth, its equivalent price would already exceed $200 per ounce. The structural tightness in supply is now undeniable. For 5 consecutive years, global silver demand has outstripped mine production, a deficit driven not just by investment demand, but by essential industrial usage. Yet most silver still comes as a byproduct of base metal mining, meaning higher prices do little to increase output. This creates a feedback loop of scarcity, one that amplifies price volatility when investor capital finally floods back into the market. In Oliver's view, when that moment arrives, traditional technical metrics like RSI or moving averages will fail to capture the true magnitude of the move. Overbought conditions, he reminds us, can persist for months during genuine market revaluations. The broader context is equally compelling. As equities, particularly AI-linked tech stocks, begin to lose their leadership position, gold and silver are quietly breaking out against the major stock indices. The spread between gold and the Dow has already surged, while the gold to S&P ratio is on the cusp of doing the same. Historically, these cross-market breakouts precede long-term bull phases for metals and the miners, just as they did in the 1970s and early 2000s. Oliver interprets this not as a speculative blip, but as confirmation of a multi-year rotation already underway. As the walls of the 50-year silver range finally crack, the acceleration phase may unfold faster than most expect. This won't be an incremental climb, it will be a repricing, a reset in how the market values real assets in a world awash with depreciating fiat. For patient investors, the signal is clear. Stay the course, hold your conviction, and watch the spreads. Thank you for watching. If you value in-depth market intelligence and precise technical insight, don't forget to subscribe, like, and share this video. Stay tuned as we continue tracking the unfolding shift from paper wealth to tangible value. A cycle that, as Michael Oliver reminds us, is only just beginning.